Looking at markets on Wednesday, there isn't a whole lot that stands out. There's a clear uncertainty about direction after Monday's sharp sell-off in risk assets was followed up with the usual supported bid into the dip. And so we wait to see if it will be more of the same with those bids fueling U.S. equities back to fresh record highs, or if we're maybe into a new phase where risk assets are better seen as sell opportunities into rallies for fresh downside extensions. The euro has gone not really anywhere at all today, and the pound has barely nudged, while the yen and Swiss franc have absorbed some risk liquidation demand, yet not enough to force these currencies back to their weekly highs against the US dollar. But if there's one market that seems to be taking this recent round of risk off more seriously, it's definitely the gold market, with the yellow metal extending its multi-month gains through a major psychological barrier at 1500. The move is aligned with feeling of uncertainty over the outlook of the global economy, while also reflecting the type of price action one would expect if the yellow metal is convinced the U.S. administration will be effective in weakening the U.S. dollar. Gold will now be looking for a push back towards the record high from 2011, when the metal stalled out just ahead of 2000. The president continues to express his critique of the Federal Reserve and would like to see additional rate cuts, replacing what he describes as the ridiculous quantitative tightening approach. And the need for additional accommodation hasn't been lost on other central banks either, with the RBNZ surprisingly cutting rates by 50 basis points earlier today, despite calls for 25 basis points of cuts. On the data front, German industrial production was discouraging, but didn't really factor into price action. Looking ahead, Thursday's calendar features China trade, the ECB bulletin, Canada housing data, and U.S. initial jobless claims. That's all for now.